Well, good afternoon, everybody. This is Tim Kelly, and welcome to Homebuyer Finance 101. This is something that I have had the pleasure of doing for several years now, and I have taken my live class to the internet and streamed it live here on YouTube. So I'm excited. I'm really happy about the presentation today. I think we're going to get a lot of information. If you are watching this live, please interact. Let me know where you are watching from. If you have any questions, go ahead and drop them in the comments, and we'll do our best to, or I will do my best since I'm running this solo, to answer your questions. And what we're doing here is we're just talking about first-time homebuyer programs and benefits. This is very high level to kind of entry level to get you started if you are thinking about purchasing a home in 2026 or at any point. So it's a really great place to start. So let's just jump into it. And again, I'll just continue to monitor the chat on this live stream. And if there's any questions, I will do my best to answer those. And if you are watching this after we've gone live, I'll monitor the comments so you can drop questions. And if there's anything that you want me to add on any future show, please don't hesitate to reach out. So we got one question already. Let's see if I can get this added. And here we go. Is this relevant to the UK? So this is not. This is specifically for the United States of America. I am a loan officer licensed in Virginia, Maryland, DC, and North Carolina. But the products and things I'm going to be talking about in today's presentation really relate to anywhere in the country. We can really narrow in on specific products later on in this presentation when we get to it. But for right now, this is just a very broad overview of buying a home here in the United States. From my experience, things can be very different all over the world. And in some cases, there are some unique opportunities and programs here in the United States, depending on the county or the state that you're looking into. So this is Homebuyer Finance 101. Like I said, I've done this many times. Compliance, anyone who cares about that, go ahead and pause the screen now. You can see got all the proper disclosures there. But I am simply just giving you my opinion on the market on these programs as a loan officer with over 18 years experience. Before we get started, what you need to understand is how the mortgage market works. I think this is going to be really helpful throughout this presentation. This is an explanation that I've used several times, and I think it really does a good job of painting the picture of how getting a mortgage is similar to buying a car. Because in my experience, many people have purchased multiple cars in their life, and very few, or not very few, but you've purchased very few homes compared to the amount of cars you bought. So with that in mind, the way I like to kind of explain it is we have two markets within the mortgage industry. We have the secondary market, we'll talk about that first, and then the primary market. So think about the secondary market when we compare it to buying a car as the manufacturers of the mortgage products. Just like if you were buying a car, you've got the auto manufacturers, Toyota, Ford, Tesla. They basically build the cars, okay? And unlike, or just like that, you have Fannie Mae, Freddie Mac, and Ginnie Mae. They basically create the mortgage products that we, mortgage lenders, are going to provide you, to sell you. So just like you were going to go buy a car, if you wanted a Toyota Camry, you can't go to the Toyota dealership and drive that Camry right off the lot. You need to go to the dealer and buy the car from the dealership. Mortgages are very similar in the fact that if you want a conventional loan, a VA loan, we'll talk more about those later, you can't go to Fannie Mae, Freddie Mac, or Ginnie Mae directly and get the mortgage. You've got to go to the local dealer, the mortgage lender. And so inside that mortgage lender world environment, we have the primary mortgage market, which consists of mortgage bankers, mortgage brokers, credit unions, and banks. Okay, and we all do the same thing. We're all selling you the mortgage. It's at the end of the day, a mortgage is a commodity. Okay, think of it like a commodity, just like that Toyota Camry. If you went to any dealership, it's going to be the same Camry, no matter where you went. What's going to be different is your experience buying that Camry, and possibly the cost. And so if you're going to get a conventional mortgage, it doesn't matter if you go to a mortgage banker, a broker, a credit union, or a bank, it's the same conventional product, right? Just like it's the same Toyota Camry. It's got 4 wheels, a steering wheel, a windshield, and seats. The conventional loan you get is basically going to be very similar no matter where you go. It's just going to be a different cost, different lender fees, different interest rates, and a different experience before, during, and after the transaction, just like buying a car. So I hope that kind of paints a good picture of how this industry works. Think of it very similar to like purchasing a car. I, for example, am a mortgage banker. I am a correspondent lender. And what that means specifically, it's kind of like a CarMax. Think about, I have many different vehicles, many different mortgage products within my lot, within the company that I work for. And so when you have a client that comes to us, what we can do is we can find the right vehicle, find the right mortgage, and customize it for them and their specific needs. Whereas if you were to go to a bank or a credit union, they might have some unique niche programs, but their product offering might be a little bit more limited. And a mortgage broker, they don't essentially have a lot. It's not their products that they're selling. They're basically acting kind of like a middleman. They go out there and hunt and try to find a great deal, but they have a little bit less control than the mortgage banker has. Okay, so moving on. Before you get started, there's a couple things that we want to talk about, okay? And that's there on your screen, from creating a household budget to avoiding pitfalls. And we're going to quickly walk through all of these one by one. And the first thing, and probably the most important thing, especially when buying your first home, is establishing a household budget. I can tell you from personal experience, the first house we purchased, my wife and I, we were house poor. We didn't really have a budget. And some would say we don't have a budget to this day, but it's really going to help you out in your experience being a homeowner, getting on the property ladder to have a household budget. And there's so many different forms and even apps that you can use to create that household budget. The thing you see up on the screen here, this is a budget worksheet. If you just Google Freddie Mac budget worksheet, you'll see a similar worksheet to this on the screen. And what I like about this is it kind of walks you through possible life changes, going from renting to owning. And with that being said, you also need to understand, after you buy a home, your life is going to change. Perhaps you get married, perhaps your household size grows or changes, your needs change, and so your budget's going to change. So it's really important that you have a budget that's flexible and one that you can kind of forecast into the future. But you don't want to start this process, you don't even want to consider buying a home until you have that household budget started. Get as detailed as you possibly can, but it's really important for you, because this is your mortgage. You're the one that's going to be making the payments, not the lender, not your real estate agent. It's you, that this house that you're purchasing fits into your budget and it fits into your lifestyle. My advice is don't change your lifestyle drastically when purchasing your first home. You want to, if you're used to going out to eat a lot, if you're not able to do a lot of the work that a home needs to be properly maintained, make sure you're budgeting that into putting that into your budget so that your lifestyle isn't going to drastically be different and you're going to be really stressed out and unhappy with buying a home. Okay, but just some great budget worksheets. This is an example. Again, just Google Freddie Mac budget worksheet and you'll see an example of this on the screen. Once you do that, you want to check your credit. This is something that you can do, and I've done a video on this. You'll see the thumbnail there on the screen. In the past, you are entitled to a free credit report every single year. You go to annualcreditreport.com, and you can get a copy of that. And there's a credit checklist, a review that you can go through to make sure everything is accurate in your credit, from your name to all the trade lines that appear. And if there are any errors, you want to make sure that you dispute them. And you want to do this as early on in the process as possible, because if you are starting this house hunt and you find a home you love, you don't want to have your credit pulled by a lender just to find out that there's errors that can cause delays or cost you more money. So it doesn't matter when you want to buy a home. If you are entitled to that free credit report every year, take advantage of it. Again, annualcreditreport.com is something you can go to every single year. You can do it online, or there's a form where you can send off and get it mailed to you as well. But check out that video, because there's a lot more information that I've gone into about your free credit report and how to review your credit report for accuracy and make any corrections. Once you've done that, you want to start saving. Okay, if you have that budget worksheet completed and you say, okay, we want to have a $3,000 mortgage or $3,500 mortgage, start living like you have that mortgage payment already. If your rent's a little bit less, take the difference and put it aside to savings. But when you purchase a home, you are going to need money. Even if you take advantage of a lot of first-time home buyer products and programs, grants, you still need to have money to maintain it. And having money in the bank is going to allow you to be more flexible. You're going to go in there and negotiate with a seller. They may not be able to pay for all of your closing costs. You can have gaps in the appraisal. You can have some real estate commission that you're responsible for. You've got to pay for a mover. You've got to pay for inspections. You've got to furnish the home and, again, maintain it over time. So it is important right now, if you want to buy a home next month, next year, or 5 years down the road, that you start saving for that. And there's a lot of different ways that you can do it. But just start simple. If you have that budget worksheet and you've established, like, okay, I'm comfortable with this payment, and just start living like that and putting that savings aside for the possible need for a down payment, closing costs, and whatever it is to maintain it. But definitely start saving as soon as possible. Okay? And then you want to find a lender. So once you've done your budget worksheet, check your credit yourself, make sure everything is accurate, and you start a plan to save for your home, you want to start looking for a mortgage lender. And I always put this step first ahead of the real estate agent, just because I am a mortgage loan officer, and so I always think it's important to know your numbers and get pre-qualified before you start going out and looking to establish a relationship with a real estate agent. So there's a lot of different ways you can do it. Obviously, you don't have to use a local lender, but there are some benefits, at least in my opinion, to using a local lender compared to just going online and finding someone out there in the ether. So one is the product knowledge. Like, for example, here in Virginia, if we're working with a first-time home buyer that's purchasing a home, we can look into whether or not they're able to qualify for any particular grants or down payment assistance or other benefits that they get for purchasing the first home here. And it can go down from the state to the county level to the even city. So it's really important to have that local loan officer that can look out for those options for you, where if you go online, again, it's a commodity, right? They're just going to put you in that box that fits the conventional need of the FHA product and just send you on your way. So there's a lot of benefits to using a local lender. Not only do we have great products, we also have great reputations, possibly with some real estate agents. So if you're in a competitive situation, perhaps we know the listing agent, we might be able to put you in a good position to get your offer accepted above any other offers. And many other reasons you can see there on the screen. If you have any thoughts or comments about working with a local lender, let me know. But I don't think there's anything wrong with that. I think, from my experience, local has always been better when getting a mortgage. Location. You also want to kind of have an idea where you want to buy a home. I know this kind of seems strange to talk about this, but where I am in the DMV area, so I'm right outside of DC, about 30 minutes, you can have people that are looking in Maryland, DC, and Virginia. And it's important to kind of have an idea of, like, well, Virginia's my number one, and we're going to try to buy a home in Virginia. But if things don't work out, perhaps we'll start looking in Maryland as well. That happens all the time. Homes are priced differently. But what's important about the location now is because products, programs, especially your first home, are usually going to be offered through local agencies, local housing agencies. So there's a difference between Virginia versus Maryland, the products that are offered, if you are trying to take advantage of those first-time home buyer benefits. So again, make sure you establish the location. You're not writing anything in stone, okay? But have an idea where you want to purchase, and make sure that your loan officer is licensed in that area that you're looking to buy in that state. And again, your agent is as well. And if you don't end up buying in that area, you do go to another state, if there's a flexibility, their option where they can still help you, or if they're going to help refer you to somebody else. But have a general idea of where you want to buy. And with that being said, you also have an idea of what type of property you want to purchase. There's differences here in the DMV area. We've got everything from co-ops to single-family homes to farms. It's a wide variety of products from 1 unit to 2 units. If you want to have a general idea of what type of property you want to purchase, and then, again, I know it seems kind of strange and silly to say it, but it's important, because if you are coming and talking to a loan officer and you say, well, I want to buy a condo, we need to start budgeting in that condo fee into your qualifications. We don't know what it's exactly going to be, but we need to make some assumptions. Hey, your condo fee could be $300 based on your price range, or it could be, we've got condo fees here in the DC area that are over $1,000. So have an idea of where you want to buy and what type of property you want to buy, and just understand as you start this house hunt, it is okay to change. I know my wife and I, when we bought our first home, we were looking in, if you're familiar with Northern Virginia, we were looking and under contract at a property in Prince William County, and ended up purchasing a home in Fairfax County during the whole search, and just kind of made a big pivot in the middle of it. And it's just normal and it happens. But you want to start with some expectations, start with the communication with your lender and your real estate agent to say, I'm looking in this area and I'm looking for this type of property, especially for the real estate agent who's going to help you find that type of property in that area, because you want to find an agent that has experience and is able to help you navigate the market. And the market is changing. I think 2026 is going to be a phenomenal year for first-time home buyers. I think we've had a really difficult market for them over the past couple of years, but I think going forward, 2026, I think there's going to be a lot of opportunities to negotiate, to get some contingencies in there to protect yourself as a buyer. And you want to make sure that you're working with a real estate agent that has experience with that, because the market the last couple of years has just kind of been like, put your best offer on a piece of paper and send it in, and all they do is just kind of administer it from there. But going forward, you're going to need to get negotiate your appraisal contingency, your home inspection contingency, well and septic, and so many other things that are there to protect you as a buyer. And you have the opportunity to negotiate every single aspect during this process. And so you want to make sure that you're working with a real estate agent that has the knowledge and the skills to be able to advocate for you during this process. And so there's a lot of great ways and great agents out there, but this is the largest transaction you've probably ever made in your life. You need to think of it as a business transaction, not a personal transaction. So even though you have a close family member or friend who might have their real estate license, perhaps not going to be the best fit for you, and you might be better off going about and finding and establishing a relationship with a real estate agent that you know is going to get the job done for you. When you're interviewing agents, there's some questions I have there up on the screen that I would definitely save and make sure you ask. How often do you work with first-time home buyers? It's a big difference between working with a first-time home buyer who's someone who just helps move up buyers or investors. How competitive is the market, and am I buying at the right time? Again, every market is different. Real estate is local and hyper-local, so you want to make sure that this is the right market for you, where you're able to get in there and negotiate with the seller, ask for concessions, ask for inspections, and again, ask how they help you win. It's not just a person who helps you figure out the most you can offer on a property and puts it on a piece of paper and sends it into the seller, but are they able to negotiate for you and get you the best deal possible? And really the most important thing is communication. You're going to be spending a lot of time with that real estate agent. You want to make sure that you have not only their trust, but also that you're comfortable and able to speak freely to them. If you don't like this or you feel uncomfortable with something, you don't want to feel like the agent is kind of strong-arming you or making you feel silly for feeling the way that you do. You want to have a really open, a really good line of communication with that agent, and establish how often can you reach out to them. I know we've had clients, over my career where some of them, can't sleep at night, and so I always tell them, hey, well, I'm available. Shoot me a text. If you have something is stressing you out, and I'll get back to you. If there's an agent out there that's the same way, again, just be like, hey, when can I text you? When can I email you? What's an appropriate time? I want to be respectful of you and your time. So just help me know when is a good time for us to communicate. And it's probably one of the most important relationships you're going to have in your life. Again, this is probably one of the biggest purchases. So make sure you're choosing the agent that's right for you, not just going with that friend or that coworker who just got their license. And plan for flexibility. This is really important, and it's something a lot of people don't do. And I think this is why I've seen so many headlines and statistics about why people have a lot of regrets when purchasing their first home. It's because they weren't in a position to be flexible. So what I mean by this, it's going to put you in a position for success, because you don't want to be stuck being like, I have to close on this house because my lease expires and I have nowhere to go. You want to be in a position where you have plan A and plan C in case things do not work out, right? Like, for example, if you are going through this process, you find a home you love, you get it under contract, and then during the home inspection you discover that there's mold. Okay, and that could force you to put a pause on things, right? Do you want to even move forward at all, or do you want to have the proper professionals come in and then do an inspection and remediate it properly? That can cause delays. That can cost a lot more money. So you want to make sure that you have the option where you're not going to be stuck and forced to just keep moving forward with a property when you do not know it's the right one. So I am doing this from home. I have my son blowing up the chat. He's watching me from my channel asking for food. So Jack, of course you can get food whenever you want to. I don't know what you need, but I cannot get the food for you, but you are welcome to come down and get it. Just like buying a home, you got to be flexible. Just like live streaming a first-time home buyer class, I've got to be flexible. It's going to put you in a position where it protects you financially. Again, if you're in that situation where you're buying a home and something seems a little bit off, you want to be able to pull the plug and wait to find the right home. Really, really important that you plan for flexibility. Again, it could be, I know my lease is ending in March, and I'm going to go try to find a home and close before my lease expires. But if that doesn't work out, call your parents and be like, hey, listen, plan B, worst case scenario, can I come and stay with you for a couple of days in case I need to pull the plug on this home? Or plan C, find a short-term rental. Have a plan A, and let's hope everything works out smoothly for you with no issues, but be prepared to pivot and go to plan B and plan C. Be flexible. It will save you in the long run. So the pitfalls, this is really important. You want to make sure when you're going through this process that you avoid these things. And life happens. We understand it. There's, sometimes nothing you can do about it. But here's a couple things that you can try to avoid. Number one is too many inquiries on your credit. You have the ability to shop around and find the best deal for you and the best product for you, but you don't want to overdo it. Usually 2 or 3 lenders and you'll be fine. Do not co-sign any debt for anyone else. Really important. No co-signing on any loans. If you want to buy a home, you're not going to be a co-signer for anyone. Okay? It doesn't matter if it's short-term, long-term. Just do not co-sign because it can really impact your credit, because whatever that debt is that you're adding to your credit, that is now your debt, and you're going to have to qualify carrying that debt. So no co-signing. Changing employments. Now again, things can happen. You can lose your job, change your job, and that's okay. Just make sure you communicate with your loan officer. And you gotta, I can see my son left the fridge open. You gotta close the fridge, Jack. But change employment happens all the time. You get a better opportunity, you lose your job. Just don't hide it, because you might find that you can still qualify, you can still move forward. Perhaps there might be some changes to qualifications. Maybe you have some sort of commission income that now you're going into, and a sales role that we can't use that income. But if you're going from W-2 to W-2, usually you can get an idea of a verbal verification of employment, an offer letter, a trailing pay stub, and still be okay. But make sure you're communicating that very early on in the process. And if you do have that great opportunity for a fantastic job, again, that's why it's important to be flexible. Go ahead and do it. I think there's more homes, or I wouldn't say there's more homes, but you'll find the right home when it's the right time, and get that dream job if you can. And don't ignore your lender's requests. We're asking questions. We're asking for documentation for a reason, and sometimes we can be ignored. It can cause delays, and those delays can cause impacts negatively down the road for you. We're not here trying to bother you and make your life difficult. We're here to make sure that we properly get you pre-approved, that we have done our due diligence, as early on as possible, so that you can get under contract and close confidently without any sort of surprises or delays. So, the mortgage program. So we're going to talk about some mortgage products, just kind of, again, high-level stuff right now. We'll get more into the weeds, in a future video. If you have any specific questions, again, if you're looking to buy in a specific area, don't hesitate to reach out, and we can always do a video or do more information about that. But you've got, again, think of this as the auto manufacturers, all right? These are the different vehicles that are going to get you into the home. The different automobiles, the different cars, from a Toyota Camry sedan to a SUV to a school bus. They all have their place, and everyone's situation is different. Okay, but you've got conventional, FHA, VA, USDA, non-conforming and jumbo, non-QM, and then local and state bond options. In this, we're going to get through some specific examples of the first four: conventional, FHA, VA, and USDA. We're not going to go into the non-conforming jumbo world or the non-QM, because this is specifically for first-time home buyers, and the majority of people buying their first home are not using those types of products. And the local state bond options, we'll talk about it briefly, but we can get way into the weeds on that. So I'm going to kind of just give a very high-level overview of that. Okay, and again, all of these products you can get, a fixed or an ARM generally, and I'll save my opinion on fixed versus ARM for another day. If you have questions, I can do my best to answer them. But they do offer fixed and ARM products for each of these programs. So conventional loans. Okay, so conventional loans are created by Fannie Mae and Freddie Mac. I forgot to change the loan amounts here. I just realized that. The loan amounts did change here in 2026. I'll try to pull them up so I get the exact numbers, and then change in the presentation later. So every year the FHFA comes out with loan limits for conventional financing. And in 2026, let's see here, you can get a conventional loan, so a regular conforming loan. It went from $806,000, I think it was back in like 2024, to $832,750. So that's anywhere. If you're in a high-cost market, which Northern Virginia, the DC metro area is, parts of California, New York, Alaska, you can get a conventional loan, a conforming loan, up to $1,249,125. So I'll be sure to update that later on the slides. But if you're buying your first home with conventional financing, you can put down as little as 3%. Okay, and if you're in that high cost, from $832,750 to the just under $1.25 million, then your down payment goes from 3% to 5%. But if you are buying your first home, 3% down on conventional loans. Okay, you are required to escrow your taxes and your insurance on a conventional loan if you're putting down less than 10%. What that means is that when you make your monthly payment, you are also making a 1/12 of your annual tax and insurance bills as part of your payment, and that's going into an escrow account for you. The credit score used to be a 620, but now they've removed the minimum credit score, and it's based on when we see AUS, that stands for Automated Underwriting Software. So they can vary. Again, looks at reserves, debt-to-income ratios, and will determine whether or not you're going to be approved with your credit score. We have done loans for people with no credit. No credit is better than bad credit when getting a mortgage. There are options out there, and you're not seeing it as big of an impact to your credit score or your mortgage insurance requirements when you have no credit. But generally, you want to try to get as high of credit as possible. It's really going to open the doors to more options and better terms for you. Your debt-to-income ratio could be up to 50%, and that's your gross monthly income. So again, you establish that household budget. Don't let your lender tell you what you can't afford, because we have no idea. We can just tell you what you could qualify for, okay? But you can get a conventional loan and generally have your debt-to-income ratios be up to 50%, which is pretty high. You're going to have mortgage insurance if you put down less than 20%, but don't let that scare you. That's not a bad thing. Today, mortgage insurance is more affordable than it really has ever been, and you'll be really surprised when you run the numbers. You can put down 3% to 15% and pay for mortgage insurance, and it really just doesn't move the needle too much. It does allow for gift funds, non-economic co-borrowers, and you can negotiate seller concessions. So conventional is kind of like, we think about the cars. That's your Toyota Camry, your Honda Accord, your Civic. That's like the most common vehicle that people are using to purchase homes. A really great, reliable product. You're going to get good interest rates. Again, the higher your credit score, the better those will be. Same with the mortgage insurance. You're going to be really competitive there, where if you have lower credit scores, a good option possibly is going to be FHA financing. FHA is not just for first-time home buyers. Again, the loan limits there I forgot to change, but you can do it up to on a one-unit property up to $1,249,125 here in the DC metro area. Again, we're a high-cost market. Depending on where you are, that might be a little bit different in the country, but here we are a high-cost market, so you can get a VA loan for over that 1.2 million, FHA loan. You are required to have your taxes and insurance being escrowed with FHA. It allows for lower credit scores. Again, Fannie Mae, Freddie Mac got rid of their minimum credit score requirement, but you'll see it be a significant price increase to your interest rate, your closing costs with that lower credit score, whereas FHA basically treats your lower credit score similar to a higher credit score. It's a government loan, and in the eyes of the government, they see everyone, regardless of their credit score, their income, as being equal. So you're going to have the same terms. You're going to have the same mortgage insurance requirements no matter what your credit score is. Whereas conventional, that lower that credit score is, the higher the cost, the higher the mortgage insurance is going to be for you. It does allow for gift funds. It does allow for non-incumbent co-borrowers. It does allow for a seller concession. And this feature that you probably heard of recently called assumption, this loan is assumable. And so what that means is that you can go out there if you want to use FHA financing, and there might be someone who has a FHA loan currently, and you can assume their loan. You can take over their current loan, but you'll be responsible from the difference of their loan balance to what they're selling the house for. So you don't see a lot of people assuming loans because of that fact. They have a difficult time trying to find affordable financing to help bridge the gap when they're assuming a loan. But it is a nice feature that you'll see on these FHA loans. It's a great product, not just for first-time home buyers. You can be moving up, buying your second or your fifth home and using an FHA loan. Really where you see people use FHA over conventional is due to their credit score. VA, this is only for veterans, active duty service members. If you are, this is probably the product you'll end up using. It's a phenomenal product that allows for 100% financing. It does not have monthly paid mortgage insurance, but there is a funding fee, and that funding fee typically is, for your first time, is going to be 2.15% of the loan size. It could be different depending on if you're using your VA entitlement for a second time, or depending if you have retired from the military with any kind of disability. It's possible that you could be exempt from that. I'm doing a whole class on VA loans in the future, so be sure to check back on this channel where we'll really dive into VA loans, because it's a great product to do a lot of those. Again, you can use seller concessions to pay for your closing costs, and this is also assumable. USDA loan, you don't hear a lot of people talking about this product as much as the others, but it's a really good product. If you are looking a little bit further out, and sometimes first-time home buyers are because of affordability issues, you might want to check out USDA. It allows for 100% financing, but it's only available in certain areas that are considered rural by USDA. But it's very similar to FHA in the fact that there's upfront and monthly paid mortgage insurance, which is required for the life of the loan. But the difference is there's no down payment. There's also an income cap, so we have to run you through the income eligibility matrix to make sure that you are able to use USDA financing. But it's definitely a good product that I would not overlook if you're buying your first home and you're looking a little bit further out. You might be surprised what is considered, or what is USDA eligible versus not. And then non-conforming, again, these are loans that are above the conforming loan limit, the $1,249,125. I'll change that later on the slide. Jumbo loans. You can still use a jumbo loan if you're borrowing below that amount. And why you would is sometimes, depending on your credit profile, you might find out the jumbo interest rate is better than a conforming rate, the conventional loan. And so what we do, again, correspondent lender, we put everyone into our pricing engine and we figure out who's got the best rate for that particular scenario. But we do have a lot of clients, every now and then, they're better off using a jumbo product than a standard conventional loan. So we can make sure that they qualify. There's a lot of extra overlays and guidelines that you have to make sure that you can meet when using a jumbo loan. And then non-QM, these are loans that are called like non-qualified mortgage. They don't fit into the box that we just mentioned. These are where you see, you might hear DSCR. That's a a non-QM product that we don't really need to talk about for the purposes of this class. And then there's local and state bond programs. So here in Virginia, we have Virginia Housing. In Maryland, they have the Maryland Mortgage Program. So you can go check out in your state, if you're watching this from anywhere in the country, go to hud.gov/states, click on your state, and you'll see who your housing agency is. Typically what you can do is you can get a conventional FHA or even a VA loan through your local or state housing authority. And why you would do that, well, they might have some incentives that you can take advantage of, like a grant. Here in Virginia, we have a 2% first-time homebuyer grant. We also have a Community Hero grant for $10,000 that you can use on top of that 2% grant. And that's where, again, using a local lender, we can make sure that if you do qualify for any of those products, we're not the one that's going to be making the mortgage payment, but our job is to make sure that you're aware that those products and those grants and programs are out there. So we can look into the local housing agencies to see if that's an option for you. And any local lender should be able to do that for you. And you can do your own research, hud.gov/states, about those products. So after you get pre-approved by the lender, you're going to kind of go through these, and we'll quickly, run through these here in the presentation. I don't see any questions, so I'm just going to keep moving forward. So working with a real estate agent, there's so many benefits. This has kind of changed over the past couple of years because it used to be kind of before 2024, where your agent's commission was already negotiated by the listing agent and the seller. Technically, you were, and there was a lawsuit that happened, and the reality behind it is technically you were paying for your buyer agent commission by purchasing the home, and that commission was coming out of the purchase price. So this lawsuit happened. It was a pretty big deal in our industry, and now you as the buyer are going to establish a buyer agency agreement with the real estate agent, where they're going to say, you can work with me, and they'll go through all the benefits of why to work with them, ask the questions that we went through earlier in this video to make sure you're comfortable with them, and they're going to say, okay, if you want those things that I provide, these services, it's going to cost 2%, 2.5%, or 3% of the purchase price. And you're going to sign that buyer broker agency, and you're responsible for that commission. Now, how it usually works, or can work, is you can go to the seller when you make your offer and say, hey, Mr. or Mrs. Seller, I'm going to buy your home for X amount of dollars, but I want you to give me or pay for my real estate commission, which is 2%, 2.5%, 3%, whatever it is. So you can, when you make your offer, you can ask the seller to pay your buyer's agent commission, but if you're in a competitive situation, or for whatever reason, it may not be a guarantee, and again, that they pay for it, and if you sign that buyer agency agreement, you might be on the hook for the difference of the full commission, or 0.5%, 1/4%, whatever it is. So again, make sure that, number one, the real estate agent that you work with is worth the money, because that's a pretty big check right there, that they're truly helping you negotiate the best deal possible, find the best home that meets your needs. But in my experience, there's so much value when it comes to working with the right real estate agent. You'll see there on the screen, they've established timelines. They kind of make sure everything stays on course. They're the ones that are really holding your hand throughout this entire process, whereas the lender, such as myself, we provide the loan, we provide the financing. But they're the ones that are really your advocate for every step of the way. They can help, if you're not familiar with the area, they can help you determine the location, understanding the market conditions, and again, the market can shift quickly, especially here in the DC metro area. We've seen a lot of shifts over the past year. Make sure they are a powerhouse negotiator. They're going to get you the best deal possible. And again, there's paperwork and contracts that are not just there to protect the seller and commit you to moving forward in the transaction, but they're also there to protect you. So if you have an appraisal issue or a home inspection issue, you can use the contract to get out of the deal and get your earnest money deposit back. So a lot of value in working with the right real estate agent. And you want to plan for expenses. Even if you are using 100% financing or a grant, you typically going to have to write some checks out of the gate. And so that could be your earnest money deposit. And that's like a good faith that if the seller accepts your offer, you're getting some skin in the game, you got some money on the line that you're going to perform on your end as a buyer. That could be anywhere from a few $1,000s to a few percentage points of the purchase price of the home. You're also typically going to pay for your home inspection and your appraisal prior to closing. That's what POC stands for, prior to or paid outside of closing. And that can range anywhere from $300 to $500 to more, just depending on the size of property and the location. And if you're buying a condo, you may or may not have to buy and purchase a condo questionnaire or condo documents prior to closing. And then when you go to the settlement table, you're going to have closing costs as well, and that can range, from my experience here in the DC metro area, that can be anywhere from 2.5% to 3% of the purchase price. And that's pretty common, I think, throughout the entire country, be somewhere in that range. And that is money that's going to be paid at the closing table. So again, working with the right real estate agent, it's possible. Perhaps you can negotiate with the seller to pay those closing costs, all or some of them, for you. There are limits and caps to the amount of concession you can ask for, and it's important to note that the seller credit or any interested party contribution can only go towards your closing costs, prepaids, and escrows. It can never go into your pocket at the closing table, nor can it ever go towards your down payment, only towards your closing costs. And then really, really important, and we talked about the savings and how important savings is in the beginning of this, but prepare for after closing costs. Utilities, repairs and maintenance, water, trash services, HOA, condo dues. You're going to have costs buying a home on top of your mortgage payment. I've done a lot of digging around, and every cost for maintaining a home is going to be different. A condo versus a single-family home. But for what I've seen and what I've experienced, at a minimum, the annual cost to maintain your home, plan for 1% of the value of your home. So if you buy a $500,000 home, a townhouse, a condo, doesn't matter what it is, just plan that you're going to have expenses around $5,000 a year just to maintain the home. So start building and saving and planning for that as well. Okay, and it can be different if you're in a coastal area where you've got different weather. Your home could be deteriorating at a faster rate and need more maintenance. So every area is different, but I think just blanket statement for this video, just plan for 1%. So again, you've gone through this process. We talked about the pitfalls in the beginning. It's important to talk about them again because these are pitfalls. They can happen at any time. So just do your best to avoid them. Make sure you're paying your bills on time when you start this process. Don't be late. I've seen it happen. You pay off a credit card, you think you're done, and that credit card's gone, but then there's recurring interest that gets tacked back onto the card. You forget to pay it. All of a sudden, you got a negative inquiry or a negative hit to your score. Or you've shopped around so much, your credit report expired, your lender has to pull a new one, and now your score dropped 20 points. Just make sure you're in good communication, you have a good relationship with your loan officer, and they can help navigate this process for you when it comes to the financing to avoid these pitfalls to the best of your ability. Be flexible. I talked about this earlier, but it's important now after you get pre-approved because guidelines can change. Rules can change, and it's not your lender's fault, your loan officer's fault if guidelines do change. And it's important, make sure you don't ignore the requests. If they're asking for documentation, get them in so they can be reviewed. We want to make sure that when we do a pre-approval letter that it's our name and our reputation on that letter. We want to make sure that it's a legitimate approval. So get your pay stubs in, get your bank statements, and again, let's hope Plan A works out for you. I'm sure it will. It does the majority of the time, but always have a Plan B or a Plan C, and work with loan officers that have experience and enough industry experience to navigate any of those possible guideline changes, right? So we always have our Plan A, this is the product we're going to use, but if something happens down the road, which it can, we discover we can't use child support income, but we need to have a Plan B. Could that be going from conventional to FHA or adding a co-borrower, paying off some debt prior to closing? So just understand things can change. Your loan officer is going to be flexible, come up with a plan, different strategy if the guidelines do change or things change when you get your documentation in, and you need to have that flexibility as well. Appraisals, I just want to talk about this because it's really important. I think a lot of first-time home buyers aren't aware of this, and your financing terms are based off of the lesser of the appraised value or the purchase price. So you may go and work with your real estate agent, get a sweet deal, negotiate with the seller, and say we're buying the home for X amount of dollars. We, the lender, are most likely going to require an appraisal. We order the appraisal. If that appraisal comes in low, all of our financing terms, all of the max loan to value ratio, the minimum down payment, all that's going to change to be based off of the lesser of the appraised value or the purchase price. Now, when we run clients through Fannie Mae and Freddie Mac's automated underwriting system, it could come out that an appraisal is not required. Okay, it is not our job to then just waive your appraisal. It is your choice. You can still get an appraisal ordered if you want to, and I have had this experience a few times where we get an appraisal waiver and the client still wants to get the appraisal done because, again, this is a large purchase and you want to make sure that you're not overpaying for the property. So that's totally fine. That is within your right to do. But not every client is going to require an appraisal. Not every appraiser is equal. Just understand there's a code of conduct that we have to follow called HVCC when it comes to ordering appraisals. The appraiser is not an employee of the lender. Usually it's this blind round robin system where we place the order out into appraisers that we have vetted and approved to work with as a company, and then just gets assigned to one of those appraisers. We don't know who it is until the appraisal report comes back, so there's some sort of protection. But a lot of people find it interesting that when we do order these appraisals, we also give the appraiser a copy of the contract. So they're not like taking a shot in the dark on the value. They know, okay, this is the number that the buyer and the seller agreed to. How do I arrive at that number? Okay, and they do their best to get there. If they can't get there, they'll usually go to the agents and ask, hey, I don't see this value here. How did you guys arrive at this? And ask for more supporting information. Or they'll come in low, and if you're working with a good agent that put in the appraisal contingency in there, you can go back to the seller and try to renegotiate some of the terms. Condos are another thing to talk about. Just because you are qualified doesn't mean the condo building is also qualified. We've had things where, especially now, as you can understand, that the condo buildings are deteriorating. They don't have proper insurance. They're not maintained well. Fannie Mae, Freddie Mac, VA, FHA, they can, make it so that you can't use that particular product to purchase the condo in that building if it doesn't meet their standards. It's not always the most pleasant call to make, saying, hey, you can't buy in this condo, or you can't use this product in this condo for this reason, but understand that the grand scheme of things, it's there to protect you. We had a client that was trying to do some financing in a condo here in Maryland, and we couldn't do it because the sprinkler system in the condo did not work. It was not operational. So if there was ever a fire or something in that building, there was no sprinkler system that was going to extinguish the fire. It's very dangerous, potentially, and so financing with conventional products was not available in that building. Again, wasn't a great conversation, but just understand you may qualify for it, but the condo itself may not. That's why we're going to go through and order a condo questionnaire. We're going to get condo documents and have those reviewed to make sure that the condo meets the minimum requirements for the type of product that you're using. Locking in your rate, this always comes up too. So after you get pre-approved, doesn't mean your rate is locked in. Your rate is subject to change for the better or worse depending on what's going on in the market. There are lock and shop products available, so you do want to probably ask your loan officer, do you offer that? And what that means is that if I'm going out and looking for a property now, and all of a sudden rates start going up, quarter, 0.5%, 1%, which we have seen in the past, your loan officer might have a lock and shop product that they can lock in your interest rate for a certain period of time while you shop for a home. It could be 60 days, 90 days, but it's nice to have it. I haven't used it in a long time because the market tends to fluctuate, goes up and down. But there was a time over the last couple of years where we did see consistent rise in rates, so we were using our lock and shop product a lot. And you're not typically going to lock in your interest rate until you have a ratified contract. At the end of the day, the collateral of the loan is the house. It's not you. If you stop making mortgage payments, we're not going to garnish your wages. They're going to seize the home. So you need to identify what that collateral is, that home, before you lock in your rate, typically. Now, when's the right time to lock in your rate? That's something for you and your loan officer to discuss. If you're happy with the rate, happy with the payment, lock it in. Don't treat your finances, your personal finances, your home, your mortgage as a casino. If you're happy, go ahead and take care of it. If you do lock in and rates fall, it is possible that your loan officer might offer something called a float down or a rate renegotiation. So you can ask that question, do you offer this? We have done that several times recently because the market has been kind of very volatile, where we see rates rising one day, so we lock in our clients, and then 2-3 weeks down the road, rates have improved significantly, and we're able to renegotiate, get them a lower rate prior to closing. But typically, you're not locking in your rate until you've ratified contract. Again, ask about the lock and shop option. Ask about a free rate renegotiation. So the financing process, I'm not going to spend too much time on this because it can be different depending on who you're working with. Again, think about the car. If you go to one dealership, their process and flow from getting in the door to getting approved for financing to getting the keys in your hand can be very different. It can be a different timeline. It can be a completely different experience. And same thing with getting a mortgage. But if you are curious, you can go ahead and pause the screen here and just see these are 15 steps typically in the order of how you work from determining if you're ready, and also budget, reviewing your credit, getting pre-qualified, reviewing your financing options, to getting your documentation in, to getting pre-approved, to going under contract and getting your loan application and disclosures out and signed so the loan officer can get your file into underwriting and ultimately clear to close and funded at the closing table so you get the keys to your home, and then the payments start for however long you locked in. Could be 10, 15, 30-year mortgage. So compare your financing options. So this is kind of where we kind of get into some numbers here. I don't like spend too much time on this section because numbers change, everybody's situation is different, but this is the best way that I think if you're buying your first home, you have to look at the mortgage. You don't want to limit yourself to one particular product. You want to start off looking at every product that's available to you, from conventional financing to USDA financing. And as you start your search, you can narrow in on what product meets your needs best, and use that vehicle, use that product to get you into home ownership. So in all these examples that we'll go through here in a moment, these are based off of this particular avatar, this client, which is a single first-time home buyer. They're paying $3,300 of rent per month. They've got good credit, over 740, making $95K a year. They've got $50,000 saved and have a monthly debt of about $750. And we're comparing a same property side by side, so we're looking at a $525,000 townhome. So I'm going to go ahead and make this bigger so you kind of see the numbers here. So conventional 3% down. So again, this is within the regular conforming loan limit, so you are able to use a conventional loan and put down 3%. So in the first column, we are comparing renting of $3,300 with a $50 a month rental insurance to purchasing this property for $525 and getting a mortgage. Now, the interest rate on this, I created these slides back in March of 2025, and I don't think it's important to adjust the current interest rates because it's not the point of this video, because rates are subject to change at any moment for the better or worse. Just understand the concepts, 3% versus conventional loan versus FHA. So in this case, your mortgage payment is about $4,200, $4,180. Your cash out of pocket, assuming you did not negotiate any seller concession, is $30,316. Okay, so that's great. That's a 3% down conventional. But what does it look like down the road? Well, if you compare the net payments, so this is your payment after any tax savings. And again, I'm not a tax professional. Consult your CPA to see what your actual tax savings are going to be. But it really kind of evens out. We go from almost $4,200 a month in rent, but after your tax savings, because you're able to deduct mortgage interest, that drops down to $3,700. So not too much more than what you're currently paying in rent. If you factor in the rent over time, you're paying over 3 years about $126,000 in rent, assuming, I believe, a 5% increase on your rent per year, to putting $17,839 towards your principal. Again, mortgages are kind of forced savings. When you have a fully amortizing loan, you're paying down a loan each month with a mortgage payment. And then if you were to compare you're a 3% down conventional loan to a renting for 7 years, that $50,000 earning about 4.5% becomes just under $71,000, whereas your estimated net worth, assuming the home appreciated every single year, about 4%. The difference between the $30,000 you had in the bank versus I guess after your closing, you're about $20,000 left in your appreciation. Your estimated net worth comes out to be just over $257,000. So there's really no quicker way to build your net worth, in my experience, than through real estate. It's a great way to increase your net worth. But if you were to put down 5%, because you're putting down a little bit more money, things start to improve. You can see here that your monthly payment goes down. Your cash to close goes up because you're putting down 2% more, right? So almost $10,000. But your mortgage insurance is improving as well. You can see that because of you putting down a larger down payment, you have a lower likelihood of defaulting, so the mortgage insurance is going to be a little bit more affordable for you. Same thing, compare the net payments to what you're paying in rent. The net worth 7 years down the road, you're better off going with a 5% down conventional loan than continuing to rent for $3,300 a month financially. FHA financing. Again, this is your first home. Look at all the options that are available to you. You could rule out FHA for yourself if you have a very well-qualified candidate. Usually conventional financing will be more affordable than FHA. It's all depending on that credit score. But if we compare that same client purchasing this property with FHA financing, their monthly payment comes out to be $41.88. Their cash to close, because it's 3.5%, so about 0.5% more down than the conventional 3%, comes out to be just under $33,000. Your net payment, about $37 after your tax savings. Your net worth, about $250,000. VA financing, if you are a veteran, usually this is the route that most people will go, but understand that there is an impact on your entitlement, your funding fee down the road. So really have a discussion about, is this the right time to use my VA entitlement for the first time, or should I hold off? Most of the time, you can look at these numbers here. You have $4,100 payment, your cash to close just under $15,000. That's a pretty great deal. When you compare the net payments to the rent, much more even. Your net worth much higher than renting by using your VA entitlement. USDA financing, this is very similar to FHA. In fact, it has two kinds of mortgage insurance. Upfront mortgage insurance premium, which can be financed, which is how I've shown it here, and monthly paid. And you'll notice the payments, $41.58. Your cash to close is just the closing costs, prepays and escrows, because you're financing 100% of the home, so just under $15,000. Your net payment, a little bit closer. Your estimated net worth, much higher. And what you do is you want to take all of these options and compare them side by side. You can do this yourself. Your loan officer might be able to put this together in a format like this to help determine which product makes the most sense for you. So you can see here, conventional 3% down. Your loan is $509,000. If you go with some of the options like VA, you're buying the home for $525,000, and now you owe $536,000. You're kind of upside down. Same thing with the USDA option. Again, in the right circumstances, the right market, where you've got good, strong appreciation, that may not be that big of a deal. But if you're buying somewhere where the market is kind of struggling or really slowing down, just understand you are upside down, and you're going to have to be in this home for a certain amount of time before you can really sell it and break even. Okay? But notice the down payments from $15,000 all the way to $0. Your estimated cash to close, we go from $30,000 to the lowest, $14,702. But again, you borrow more, you pay more. Okay, you'll notice the lowest monthly payment is the one with the highest cash to close, and that's just math. Okay, at the end of the day, it's all math, it's all numbers. The lower your loan size, the lower your payment's going to be, your higher your cash to close. So you have to kind of figure out where you are on the seesaw. At the end of the day, it didn't matter which option you chose, you were better off, purchasing the home. Okay, So go ahead and just bringing it all together. So number one, establish a household budget. Okay, again, very, very important. Go to Freddie Mac budget worksheet, print it out, get a pencil, because you'll make changes to this when you kind of start working through the worksheet, but get that household budget established. Set up a buyer consultation with a real estate agent, interview them. That's one of the most expensive parts about buying a home, is the real estate agent you choose. They can earn their worth, get you the best deal out there, help you find the right home for you. That's going to be a great investment for your first home. It's a big, big decision, so choose wisely. Then get pre-qualified and pre-approved. You've got to get pre-qualified before you get pre-approved. Pre-qualifying is getting the application in. Pre-approval is getting that supporting documentation in. Review your financing options with your loan officer like we just kind of did. Get everything that's available to you. Try to get as many options as possible. Make sure that you don't have a salesperson, because at the end of the day, loan officers are salespeople that's just trying to just throw one product down your throat. Explore all of your options, and then begin your home search. Understand that the home you choose might result in a different type of financing product. Again, we talked about some of those programs earlier that you were upside down in the home. Well, it may not be the best product to use for your first home if you're buying an area that's going to slowly appreciate and take you years to break even if you do need to sell the home. Or perhaps the rental market isn't as strong or is strong, and you can go with one option and be more flexible. But just understand that when you choose your option for the type of financing, you're not committing to that until you have gone under contract and locked in your rate, okay, and signed the closing documents. So always continue to explore every financing product that's available to you. Local loan officers have great tools and resources where they can really help you do a side-by-side comparison like we were doing earlier. And then when you find a home, again, just always send it to the loan officer and get them to update numbers for you, because rates change like we talked about. You're not locking in the rate typically until you've ratified contract. So that is it for me. I don't see any questions in the chat, but if you are watching this on a replay, appreciate you. Leave a like and a comment. And definitely subscribe. I'm going to be going live a lot in 2026. Really looking forward to diving into this channel and doing as much as I can to educate as many, not just first-time home buyers, but homeowners and real estate agents as possible. So I will leave it here. Appreciate you guys. Have a wonderful new year, and we'll see you in 2026.